All right, now back to the markets. Just want to mention off the top here, Tesla, record high right now, leading the NASDAQ 100 at a record high as well. So those tech stocks absolutely on fire this week. Let's bring in Gabriela Santos. She is global market strategist at JP Morgan Asset Management. Gabriela, good to see you. I want to talk the Fed and a whole bunch of other stuff in a moment, but first have to address what we're seeing in the NASDAQ and among these tech stocks. Some people are saying, you know what? You're seeing signs of a bubble. Are you?
Thank you, Alexis. It's really great to be here with you again. Look, I think technology as a whole is just, it's been such a strong theme for many years, and it's not going away anytime soon. It's still one of the long-term structural growth themes for us. It's not only a handful of names. I think that's where sometimes investors get a little bit too myopic and only thinking about a few letters there. It's a broader theme. And so when we think about tech for the next few years, we also like to think about some of the less well-known tech names, but are so important in terms of cybersecurity, online payments, software, cloud computing. But really, tech is a theme here for us for the next decade. It's not going away anytime soon.
Gabriela, we've been thinking a lot about this week. A lot of big name, prominent whale, I would characterize as whale investors, have missed out pretty significantly on this rally. Look at Paul Tudor Jones, missed out big time in this rally. What does that mean for a market that is on fire right now? Do these big whale investors now come into big cap tech, come into the stocks that they missed and push up the market another 10 to 15%?
So I think really we've been a bit surprised with how the data has shaken out over the last 2.5 weeks. I think there was a lot of uncertainty from our part, from other investors' part, around what would actually happen when economies started to reopen. Would people feel confident enough to get out and about again? Would businesses feel like it was worth it to reopen again? So there was a lot of uncertainty around that theme. And we've started to see the data over the past 2.5 weeks show that actually the data is picking up more than we expected. And that's true whether you look at survey data like the PMIs that came out on May 22nd. It's true of higher frequency data like Google mobility. It's true of things like credit card spending. So I think what investors are seeing is actually the data turn less bad faster than expected. So for us, we're starting to get a little bit more comfortable in waiting, not just in the tech pool, which is that long-term theme, but also in slightly more cyclical sectors and regions and slightly less lower quality kind of credit. Not a full-on tilt, but more comfortable making a bit of a switch beneath the surface here.
Gabriela, what do you expect to hear from Fed Chairman Jay Powell today? Or maybe I should say, what do you hope to hear from him? And how might you be trading on what it is you hear?
So I think he is going to acknowledge that since they last met, things have turned less bad. So I do think he will mention some of this pickup in higher frequency data, the improvement we saw in the labor market. But I think he's also going to emphasize, and the committee will emphasize in their forecasts and their dots, that they see this really as a good beginning, but of a long journey of recovery. And so we're really going to be watching the forecast the first time in 6 months that they've put these together. We're going to be watching especially their forecast for unemployment. It's probably going to show their expectation that it's going to be still in the double digits by the end of this year. So for them, it's not a V-shaped recovery. It's a long recovery. And that's honestly okay for investors, for them to think that way, because they're going to signal that they're all in helping us go through this long recovery. So not raising rates anytime soon, not winding down programs. And that, I think, gives an additional confidence for investors to take on a little bit more risk here.
Jared, over to you.
Well, I'm looking at tech surging higher here, and just looking at the NASDAQ 100 heat map, we have 4 of the biggest 5 stocks in the NASDAQ 100 at record highs. That would be Apple, Amazon, Microsoft, Facebook, which is now slightly in the red. Alphabet, for that matter, also increasing here in value. But let's take a look at the, and I should mention too that Tesla at a record high, as I believe Alexis mentioned. But those travel stocks, as you can see, United Airlines to the downside at 8%, just not faring very well. I do want to also look at the bankruptcy trade because that kind of collapsed yesterday. We can see Hertz is down about 18%, Chesapeake down another 16%, Whiting down 25%. So a little bit of the froth in that coming off. And then just looking at the sectors, we have tech, healthcare and utilities and staples and communication services all outperforming, energy and financials and industrials to the downside. So those value and cyclical stocks, another day of opening losses for them. And I just want to hit the Dow Jones heat map as well. We have Johnson & Johnson up over 1%, and that's after it just announced an acceleration of its COVID-19 vaccine candidate. They're going to begin phase 1 and 2A clinical trials in the second half of July. And we can see over the last 5 days, kind of treading water going sideways, but over the last year, or at least year to date, yeah, looks like they're also treading water. They're up only 1%. Guys?
All right. Thanks, Jared. Gabriela, what are your thoughts on those healthcare stocks, in particular, those that are working on a cure, on a vaccine? We've seen some of their stocks like Moderna and AstraZeneca go through the roof. What would your advice be to investors looking at those stocks if they're not in them at the moment?
So for us, I would put healthcare in the tech bucket in the sense that it's a long-term structural theme that's going nowhere but up over the next decade. But for us, the healthcare theme is much more around demographics and the spending that's going to be going into the healthcare sector over the next decade. It's less about trying to pick that one company that's going to discover the vaccine or the treatment. I think it's very hard to try to predict that, given we have 100 different vaccine trials going on. And also, I mean, the company that does discover a vaccine, at what cost are they actually going to offer that? It's not exactly going to be a huge profit boom for that particular company. So for us, healthcare is less trying to play this COVID-specific theme and more trying to play the long-term demographic theme.
Gabriela, news crossing the wires a little while ago, Treasury Secretary Steven Mnuchin said, quote, he expects the economy to improve or, quote, improve dramatically in the third and fourth quarters. Do you think that's a reasonable expectation? And if so, despite the market rally, do you think the market is undervalued here?
I think it's all about how we phrase it. It's definitely going to improve, and especially when we compare to March and April, where we were really in the depths of the recession. So from here on out, unless we get some sort of second wave and a reshutting of economies, yeah, the data will continue to improve. I think it's also about setting expectations, though, as to the extent of how much. We don't think we're going to be able to completely recoup what we lost in those 2 tough months until the end of 2021. So that, to me, is the difference between having some optimism and just completely thinking that everything's fixed and this is a V-shaped recovery. So we're optimistic, but we still think this is going to be a long, gradual road ahead. So for us, it's willing to take on a little bit more risk, but still with care to actually pick the companies that are going to be able to survive this long recovery and actually be able to thrive on the other side.
You've said in your notes that a lot of this is dependent on the fundamentals, this rally, and how long it will last, and the strength of the rally will be based on market fundamentals. But how are those fundamentals looking to you right now, especially when you look at earnings reports, so many companies unable to give any sort of guidance?
So I think there's the overall market level. And in that sense, we've had this more cyclical rally on less bad data. Now we need to continue seeing that move in the right direction. Otherwise, the market will be disappointed and we could see a correction. But I think it's actually even more important when we think about the sector and company level, because over the past 2.5 weeks, everything has gone up. The more cyclical, the better. The lower quality, the better. And eventually, that kind of rally runs out of gas if that specific company does not actually have good fundamentals. So when we think about adding a little bit more risk, we still want to think about doing the due diligence at the sector level, at the company level, at the regional level, to make sure we're picking the right things that are going to be able to continue rallying on a sustainable basis. So sector-wise, a little bit more cyclical sectors, but we feel more confident about would be things like financials and consumer discretionary. Regionally, it would be thinking about more cyclical regions like Europe and emerging markets. And in terms of corporate debt, it would be thinking about the higher quality, high yield kind of companies.
All right, Gabriela Santos, Global Market Strategist at JP Morgan Asset Management. Great to see you today.
Great to see you. Thank you.